Very good evening, everybody. Welcome to part 2 of the 3-part webinar series on the Vix Index held in collaboration with Cboe. Tonight's webinar is titled Introducing Mini Vix Futures, Characteristics, Market Conditions, Strategies for Capital Protection and Income Generation. I'm Ming Hui from Phillip Futures, and speaking to us today will be Mr. Kevin Davitt, Senior Instructor at the Cboe Options Institute at Cboe Global Markets, as well as Mr. Matt Moran, Head of Index Insights at Cboe Global Markets. Stay tuned as they share with us on using the VIX Index to creating trading strategies, volatility strategies best suited for today's markets, and more. Before I pass this on to the speakers, I'd just like to inform you that if you have any questions throughout the course of the webinar, please feel free to drop them into the questions box as we will have a live Q&A session towards the end. And now without further ado, let's have our first speaker, Kevin, speak to us.
Thank you so much, Ming, and thank you all so much for joining us this evening, this morning, depending on where you're at in the world, pardon me, for an opportunity to learn more about the global benchmark for equity volatility, Cboe's Vix Index, and the related tradable products, including mini Vix futures. I'm glad Ming brought up the fact that this is the second in a series. The first webinar that Tim Edwards of S&P Dow Jones did is available online, and it's excellent, and you can avail yourself of that should you choose. Now, Ming and Cboe, who I work for, always point out the risks associated with trading or investing in any market. And I want to reinforce those disclaimers. There's risk inherent in every market at all points in time. Additionally, there are specific risks inherent to the volatility market that need to be understood before using these types of products. Now, we're glad that you've joined us this evening, and we hope this webinar answers your questions about the volatility marketplace. But as Ming mentioned, you can most certainly ask us questions, and in the event that we're running up against time, we get a list of these questions and the associated email, and we will make every effort to get back to you with a thoughtful response. So moving forward, the past year and a half has been a lot of things, and it's most certainly been an excellent reminder that volatility matters. So today we will learn about the tools available to try to control and manage volatility risk and potentially offset future volatility events. Over the next hour, we're going to give you a background on the VIX Index. We'll explain how it's calculated, as well as ways it's interpreted. We'll talk about the tradable futures contracts on VIX, as well as the options priced on the futures. I'm also excited to highlight the launch and early success of Cboe's mini VIX futures contract. This is a smaller sized contract. It's 1/10 the size of the standard futures, making VIX exposure arguably more accessible to a broader audience of sophisticated market participants. Now, again, remember that all market participants need to fully understand the characteristics and risks associated with tradable volatility instruments before using them. Now, we're going to walk you through some recent VIX movements. We're going to talk about term structure as far as it pertains to VIX during periods of recent turbulence. And then I'm going to introduce my colleague and my friend, Matt Moran, our head of Index Insights. And he's going to talk through some research and the ways that VIX products could be used in diversified portfolios. So without further ado, let's get started with an introduction to volatility. Now, uncertainty is ever present, and as a result, volatility is a constant. Volatility is a measure of the price movement up or down for an asset. Volatility is neither good nor bad. It is simply a way to measure the rate and magnitude of change in an underlying security, in an underlying commodity, in an underlying index. Now, while we know much or some of that potentially intuitively, volatility is often misunderstood. From my perspective, it's typically associated with negative connotations. in part because investors tend to be more concerned about sharp downward moves as opposed to steady rising prices. Now, while volatility is a calculation of all movements in an asset's price, investors' concerns tend to create a biased connection between market risk and downside market moves. Now, before we dive deeper into our VIX discussion, I would like to level set on 3 key vocabulary terms. You see them on the screen in front of you now. Our first one is realized volatility. Realized volatility is backwards looking volatility. It measures how volatile the asset value was in the past. It's also often referred to as historical volatility. And it's a relatively simple calculation based on typically close over close changes in an index security, commodity, equity, right? Now, it's also important to note that we can measure realized volatility over any time horizon. So as of April 28th, late last week, the 30-day historical or realized volatility for the S&P 500 index was 11.6%. Now, if we look back further, the realized volatility of the S&P 500 index over the past 360 days is 30%. So the past year, on the whole, has been relatively volatile compared to previous years. Again, the fact that you can chunk up your volatility segments over different historical time periods. Now, the second term here in front of you is implied volatility. Implied volatility is a forward-looking volatility that is derived from the price of an individual option using a theoretical pricing model. Now, option prices reflect several factors which are directly observable or known. So this is probably intuitive for anybody that's used options, but for those of you that maybe haven't, less so. Things like the underlying price, the time or days until expiration, the strike price, those are all known and directly observable. Future volatility, by contrast, is unknown, and as such, it needs to be estimated. So we can use an option pricing formula to calculate the market's current estimate of future volatility based on an option's current price. Now, as an example of this, as of, again, late last week, the at-the-money S&P 500 index options expiring in 30 days, so 30 days in the future, we're trading with an implied volatility of 15% compared to a realized volatility over the previous 30 days of 11.6%. Implied and realized volatility measures over the short or near-term timeframes tend to be similar, at least in part because of the tendency on our part to expect the future to look like the recent past. Now, the third and final key term is expected volatility. Expected volatility is a forward-looking market forecast that does not rely on an option pricing model. The VIX index is a measure of expected volatility that aggregates option price information without using an option pricing model to calculate implied volatilities from each option used in the calculation. That's a mouthful. I understand that. We're going to simplify it. So now that we have our terminology straight, that brings us to the VIX, to Cboe's VIX index. Now, the Cboe Volatility Index projects the probable range of movement in the US equity markets. Specifically, the VIX index measures the expected volatility of the S&P 500, so the SPX, over the next 30 days. Let's put that another way. The VIX index potentially provides a glimpse into the market's expectation for the future, and as such, it could be considered a useful forecast. Now, by contrast, implied volatility is a forward-looking estimate that changes dynamically when option markets are opened. So if we looked back at calendar year 2019, which seems like quite some time ago, 2019, the highest 30-day implied volatility level for the S&P 500 was 31.5%, and the lowest was 7.7%. These are implied volatilities for at-the-money SPX vols. Now, the range for 1 month SPX implied vols in 2021, over the past year and a half, was 9.8% on the low end and 77% on the high end back in March of last year. So as we've noted now a couple of times, the past year and a half roughly has been unusually volatile. Thus far in 2021, the range for 1 month implied volatility levels for SPX options has been more mundane. So 12.7 in mid-April and 30% in late March, when the so-called kind of short squeeze impacted some hedge funds and reverberated throughout global markets. And we're going to talk a bit more about that time frame later when we introduce or elaborate on term structure. Now, understanding the typical range for implied volatility can be a helpful reference point if you trade options or even if you just invest passively. Now, without any reference, implied volatility is a far less meaningful measure. And while 2019 represents a kind of quote unquote more typical high-low range for the calendar year, it's also important to understand that unusual things can occur quickly and option volatilities can change with an equal or greater velocity. Now, the slide you see in front of you right here was put together by Cboe's head of derivatives before he spoke to the US Congress in late 2019. And if you're asking yourself why on these dates, and it was a snapshot of the Vix index measuring 14 or 14.01 at a specific point in October. Now that Vix value implied an up or down range of 4% over the next month. And we're going to explain the math on that breakdown very shortly. Now, remember that expected and implied volatilities are both forward-looking indicators as opposed to our historical measures. Now, we notice an interesting behavior, typically referred to as mean reversion, typically emerges with forward-looking indicators like this. So if something is mean reverting, that suggests a likelihood that its value over time will return to its historical average, but we need to understand that that's not always the case. Now that we've touched upon the critical unique characteristics of those three volatility measures, let's look more closely at the VIX and specifically its methodology. All right, in 1993, is somebody having audio difficulties? Can I be heard? Hopefully somebody can confirm.
Yes, I can hear you.
All right, in 1993, the Cboe introduced the Vix methodology. It is the formula associated with the measurement of market risk and investor sentiment. When we talk about that global bellwether, this was introduced in 1993 and it's continued to grow arguably in importance since. Ming, can you just...
Yes, yes.
Okay.
I am replying.
Okay.
All right.
Very good. Thank you. Now, the Vix index is derived from real-time prices of the S&P 500 index options. This means that the VIX index formula uses option prices rather than stock prices in its calculation. These option prices that investors are willing to pay where they're transacting are a direct reflection of how quickly they think the underlying index may move. So in other words, expected volatility reflects how much market participants expect the index may move over a future period of time. Let's not forget, though, the expectations for future volatility can change quickly, which presents both risk and opportunity. Now, I like to take a couple moments to try to put some of this in perspective. And remember that the S&P 500 index represents approximately 80% of the total market value of US equities and is one of the most liquid option markets in the world. That depth and breadth of liquidity enables users to execute trades at fair and equitable prices. And that's important when you're measuring this variety of option prices. The VIX index estimates volatility by aggregating the time-weighted prices of strips of SPX options. The calculation utilizes both calls and puts over a wide range of standard and weekly SPX options. So those are the inputs, these standard and weekly SPX option strips. Now, only SPX options with Friday expiries are used. And furthermore, only SPX options with more than 23 days and less than 37 days to the Friday SPX expiration are included in the VIX index calculation. These SPX option expirations are then weighted to yield a constant 30-day measure of expected volatility of the S&P 500 index. It's a mouthful, but understanding that is important. So now that we know how the VIX index is calculated, let's look a bit further at what that Vix index value means. Now, the Vix index value is expressed as an annualized one standard deviation of the market's estimation of the changes in the price of the SPX during the next 30 days. In normally distributed data, one standard deviation should encompass the actual outcome about 68% of the time. Now, it's important to understand that equity returns are not necessarily distributed normally. Let's talk through an example and hopefully make this concept more tangible. Let's assume, to make the math relatively easy, that the S&P 500 is at 4,000, and the VIX index is measuring 20, so two round numbers. Recall that the VIX index is expressing an annualized expectation. I mentioned that a minute ago. Now, as such, the index would be forecasting an up or down, right? It's not directional, an up or down range of 20% VIX index at 20 annually for the SPX. So if we converted that to point terms, that would be a forecast of 4,800, which would be up 20%, to 3,200, which would be down 20% for the next year. In other words, plus or minus 800 points from the current 4,000 level. This information can be used to inform the market participants' understanding of the magnitude of potential market movements, as well as how those potential movements could impact their portfolio. Now, I'm going to reiterate that volatility and the VIX index are directionally agnostic. It is simply a statistical measure of how much market participants expect that the index may move over a future time frame. Okay, now I've alluded to this a couple of times. And hopefully this, again, drives home these numbers and makes them a little bit more potentially useful. I think it's helpful to be able to deconstruct the VIX forecast into different time frames for your practical application. So as I mentioned, this is like the concept I alluded to earlier with the slide presented to the US Congress and efforts to make this somewhat esoteric idea, concept, measurement more useful. So by way of example, a VIX index of 14, which was the case when Rob was putting together his presentation for Congress, a VIX index level at 14 forecasts an up or down range of just over 4% in the S&P 500 over the following 30 days. How do we know that? Well, understanding the potential up-down range forecast by the VIX depends on the square root of the time frame in question. Now, there's 12 months in a calendar year, and the square root of 12, which again is that time frame that we're concerned with, looking out a month, if that is the time frame we're concerned with, 12 is our input. The square root of 12 is equal to 3.464. You can double check that for yourself. Now, what we do is we take the VIX and turn it into a percentage. So 14% would work out to 0.14. And then we divide by the square root of our 12-month time frame. So we take 0.14, we divide it by 3.464, and that gives us our just over 4% range based on a 14 reading in the VIX looking out 1 month. So, sorry, I was just looking at the questions. It seems like this is sinking in. Let's do another example to drive this point home. Let's assume a VIX level of 30 now, not 14, 30. That forecasts a range of up or down 8.66% in the S&P 500 over the following 30 days. So how do we do the math on that again? You take 0.30 VIX index as a percentage. I'm again dividing by 3.464, the square root of 12. It's the square root of 12 because I'm concerned with a month out, and that equals 8.66%. Rules of thumb are also helpful to check your math or quick kind of shortcuts. So here's one for you. A VIX index of 16 forecast daily, so I've switched from a month out to daily S&P 500 moves of approximately 1%. Extrapolating from there, a VIX index of 32 means option prices are forecasting daily S&P 500 moves of approximately 2% in either direction. When the VIX index measured 80 in March of last year, it forecasts 5% daily S&P 500 moves. And for whatever it's worth, on many days, the S&P 500 was realizing that. The VIX index yesterday was right around 18, a little bit over that, which implies a 1.125 daily closing range for the S&P 500. The VIX index can help market participants potentially read the trends in the market. For example, how current levels of volatility compare to historically high levels, historically low levels, or that average. That information can be valuable if you're concerned about a potential shift in trends, or if you're trying to determine an appropriate hedging strategy for your portfolio. Now, a key reason that many market participants may use the VIX index for information, or another key reason that many people use the VIX index, is simply for information. And that information translating to managing portfolio risk or hedging strategies because of its inverse relationship with the S&P 500 index. Let me explain that. So volatility typically increases when markets are turbulent or the economy is falling. Now, in contrast, if stock prices are rising, the VIX index tends to decline or remain steady at the low end of its scale. When SPX index options are trading with relatively low implied volatilities and the VIX index measures between, let's say, 10 and 12, it may be potentially indicative of a complacent marketplace. Now, these lower levels, these lower values, are in a direct contrast to the levels that I just alluded to, reaching 80 in March of last year, or even it's fairly different than where we are now with an 18-20 VIX, right? So the past year and a half was unequivocally unusual from a volatility perspective. In fact, on March 16th of last year, we saw the highest ever closing value for the VIX index. That was 82.69. Now, it's worth noting that while the rate of change in 2020 was unusual, it wasn't unprecedented. There's sometimes a tendency to think this has never happened. There were periods in 2008 with similar measures. If you go back further, 1987, I'm talking about US markets here, and a stretch during the 1930s exhibited similar macro volatility. Now, moving back to the potential hedge utility of the VIX index, the correlation between the VIX index and the S&P 500 over the past 5 years is roughly negative 0.8. I'm going to explain that. The sign, so I said negative, the sign on the correlation coefficient represents the direction of that relationship, which in this case is a negative relationship. That's important. The number 0.8 is a measure of the strength of the linear relationship between the VIX index level and the S&P 500 price. Now, the correlation will change over time, but it's almost always a negative relationship. So it should come, or it may come potentially as no surprise, that investor interest helped transform this VIX index from a measurement tool into a tradable product. Between 1993, when the VIX index was first calculated, and 2004, market participants continued to ask for more sophisticated exchange-listed investment tools, specifically tradable products to get exposure to volatility. What do I mean by that? I mean that an investor could theoretically benefit from higher volatility levels in the future or lower depending on their exposure. Now, in response, or as a response to that the marketplace clamoring, Cboe changed the market landscape by creating and listing VIX futures in 2004 and VIX options in 2006. The value of these products as part of a portfolio risk management strategy became self-evident as a function of their distinct characteristics combined with their liquidity in a transparent and centrally cleared marketplace. Individual market participants, yourself potentially, and institutions alike, could now trade volatility as its own asset class in the form of listed VIX futures and options. In addition, they could potentially utilize it as a macro hedge or even as a simple exposure play, and we're going to talk a bit more about all those. So VIX futures and options exist in what I will refer to as standard contract size. VIX futures, standard VIX futures have a contract multiplier of $1,000 per point. This is the standard contract size, and it's typically utilized by an institutional type client because the range of the notional value for one VIX future has been roughly 10,000 to over 80,000 per contract over the past 10 years. Now, on August 10th of last year, as a function of customer demand, Cboe launched a smaller sized VIX futures contract with a multiplier of $100 per point. Now, To begin, and still the front 4 months were listed, and based on volume and open interest to date, we've been excited with the market's reception. Now, for some perspective, the June mini VIX future settled at 2165 on April 28th, late last week, 2165, 21.65, and had a notional value of $2,165 per contract. Now, if the mini future settled at 20, it would have 2,000 in notional value. While all this data is great to discuss, and it seems like some of the questions that are coming in are like, okay, let's see the rubber meet the road, right? Let's see how it actually applies by turning our attention to the specific ways that we observe market participants utilizing these products. And so for that, I mean portfolio hedging, risk premium yield, long short vol exposure, and term structure trading. Now, as I mentioned earlier, one of the biggest risks to an equity portfolio is a broad market decline. Typically, that's the case. Now, knowing the VIX index has had a historically strong inverse relationship with the S&P 500 index, we can propose that long exposure to volatility may offset the adverse impact of a falling stock price or a falling index equity levels. Now, market participants who utilize VIX as a part of their portfolio hedging strategy need to consider the time frame and the characteristics associated with VIX futures and options to determine the potential utility of such a hedge. My colleague Matt is going to elaborate and put some numbers around that shortly. Now, moving forward, let's take a look at risk premium yield as a strategy. Now, over long periods, and that's important, right? Sometimes our time frame isn't quite as long. Index options have tended to price in slightly more uncertainty than the market subsequently realizes. So what's that mean? Specifically, the expected volatility implied by SPX option prices tends to trade at a premium relative to subsequent realized volatility in the S&P 500 index. Remember those terms we kind of kicked off with. Typically, implied volatilities are at a premium to subsequent realized volatilities. There's opportunity there. There's also potentially meaningful risks. Now, market participants have used VIX futures and options to potentially capitalize on the general difference between expected or implied and realized or actual volatility. There's also a number of other types of volatility arbitrage strategies. We don't have the time to get into that today. Now, the third one that I mentioned is long short volatility exposure strategies. From that standpoint, it's relatively simple. VIX futures can provide a pure play on the level of expected volatility. Expressing a long or short sentiment would involve either buying to express long or selling to express short VIX futures. Alternatively, VIX options may provide similar means to position a portfolio for potential increases or decreases in anticipated volatility, but there is prospectively more nuance to the option approach. Now, last and increasingly popular in terms of volume figures is term structure trading. Now, recall one of the unique properties of volatility in the VIX index, that its level is expected to trend toward the long-term average over time, a property we referred to as mean reversion. Now, the mean reverting nature of volatility is a key driver of the shape of the VIX term structure and the way it can move in responses to changes in perceived risk. So CFE, which is the Cboe Futures Exchange, lists 9 standard monthly VIX futures contracts and 6 weekly expirations in VIX futures. So as a result of that, we're talking about 15 different futures contracts on the standards. There's a wide variety of potential calendar spreading opportunities, the difference between 1 week and another, 1 month and another, depending on expectations for future implied volatility. Now, whether you're interested in utilizing VIX futures and options as a tradable tool, keep in mind that you can always utilize the VIX index for potentially valuable market information and for a look at sentiment. So here's a brief recap, because there's been a lot of information already. And again, for those interested in more rubber meets the road stuff, we're kind of getting there. I will often get asked for trading examples, and just thought I'd give a hopefully relatively straightforward one here. Now, it's important to note that while prices for VIX derivatives are linked to SPX options generally, the valuation of VIX derivatives with different expiries can and do reflect very different portfolios of SPX options. So as I mentioned, Cboe CFE, the Cboe Futures Exchange, lists standard 1,000 multiplier VIX futures that expire each week. Cboe also lists VIX options that expire each week. And our mini VIX futures are currently listed with maturities in May, June, July, and August of 2021. Now, to determine an expiration date, you need to start by identifying the standard Friday SPX option expiration date in the next month and count back 30 days. VIX futures and options typically, but not always, expire on a Wednesday morning in the US. So, let's imagine that let's say the June mini VIX futures are trading at 2165. I'm being consistent with that level. You could theoretically buy one mini June future at 2165. Now that requires the appropriate margin and a futures account to hold that contract. Now, if the June mini future moved up from 2165 to 2265 and you sold the contract at that level, that would produce a profit of $100 US, not including frictional costs. Again, this is the mini contract. Remember that they have a 100 multiplier, which means that for every full point move, the future gains or loses $100 US. Now, had that mini future moved lower, our hypothetical trader sold out of the future they bought at 2165 down at 2065, they'd be down $100, not accounting for frictional costs. Now, another important thing to note, mini VIX futures cash settle at expiration. Okay, that's important. There's no physical delivery. Futures margins, which you may or may not know, are non-directional, meaning it requires the same amount of margin or capital to be long or short a contract. Now, your brokerage firm, in this case Phillips, might have different requirements, but you need to direct those questions specifically to a Phillips rep. All right, I've mentioned this a couple of times. It's important to note that all futures contracts have a term structure. Term structure is a plot of the relationship between prices for contracts with different maturities or expiries. In what we consider a quote-unquote normal volatility environment, VIX futures typically exhibit a contango structure, which is what you see on this screen in front of you now. That's an upward sloping term structure where longer dated futures contracts will trade at a higher level than the shorter dated futures. Now, if we looked back 5 years, the VIX futures curve has been in contango, so the shape has been something akin to this about 76% of the time. Contango for our purposes is defined as the month one futures trading at a discount or below the month two futures. So here, if I can call attention, like this is month one, below month two, and subsequent contracts are higher, right? That's the visual of a VIX term structure in contango. Now, during times of macro duress, which is typically when the market is selling off, February, March of last year, the VIX futures term structure might invert, and other people call this backwardation. Now, in those instances, shorter dated futures contracts will be trading at a premium higher than longer dated futures. Many volatility trading strategies that are predicated on what we refer to as implied volatility risk premium benefit from a VIX term structure that remains in contango, and Matt's going to elaborate on that shortly. Now, another consideration, which Matt will drive home, is when you're evaluating these tradable volatility products, is the tendency for futures contracts to move less than the index itself. Mathematically, that's quantified by the beta of VIX futures. In short, futures that are near expiration typically move with a much greater sensitivity to the VIX index than those with significantly more time until expiration. Again, Matt's going to drive that point home with some numbers. Now, it's important to note that VIX options price based on their related futures contracts and not off the VIX index. So October VIX options price based on October VIX futures. November VIX options price based on November VIX futures, and so on. What happens to those option contracts at expiration? Well, if you hold VIX options until expiration, like the futures, they will cash settle based on the expiration print. In other words, the last day to trade out of expiring options is typically, but not always, the Tuesday prior to the Wednesday morning in the US expiration. You do not end up long or short anything at expiration. VIX futures and VIX options are both cash settled. Now, in the interest of time, I'm going to explain, and I do have questions coming in. As I mentioned, we're probably going to run up against time in this thing, but we get a list of them, and we will make every effort to get back to you with a thoughtful response. Now, I talked about futures term structure, and here you see 4 different examples. The first one is January 27th. That's a backward dated, or this is all this year, and then February, the bottom one, February 19th, 2020, a contango. That was old highs for the S&P 500. Again, in the interest of time, I just want to point out that January 27th was when we had that short squeeze dynamic going on in the market. A month later, you had similar volatility, but it didn't get quite the same response. And so the VIX futures, at least in the front, the short dated futures didn't get quite as high. The curve didn't fully invert at that point in time. Understand that backwardation, so here like this pink visual, only occurs with about 20% frequency, right? Contango is much more normal. And Matt's going to elaborate and put some numbers around that. But if you have questions on this stuff, I would love an opportunity to elaborate. And just in the interest of your time and being responsive to the constraints today, know that some understanding of VIX term structure, I believe, is really, really important if you trade in volatility markets, and even just from an information standpoint, because the information embedded in the VIX curve could potentially be very, very valuable. Now, I've covered a lot of ground. I explained the 3 types of volatility that are potentially relevant to investors: historical, implied, and expected. I outlined some market history about the VIX index and the evolution of tradable volatility markets. Now, VIX options currently have an average daily volume in excess of 500,000. They're some of the most actively traded options in the world. We walked through what the VIX index is and how it might be interpreted. There's more information in the Tim Edwards presentation from a couple of weeks ago. Some rules of thumb: a VIX index measuring 16 indicates that S&P 500 options are pricing roughly 1% daily moves. We talked about the launch of mini VIX futures. I talked about some strategies that market participants employ in volatility markets, as well as the role that term structure plays in the VIX market. Now, I went on for quite a while. I think for those of you interested in that real tradable nuance, that this next section will be of particular interest. So Matt Moran, I'm going to turn it over to you to elaborate on strategies, research, topics, and performance statistics. Thank you so much.
Thank you, Kevin. And we now are on the next slide. So Kevin talked about term structure, and this slide gets into volume and price movements. And I would suggest that price movements are an extremely important topic to be aware of. So what are we showing on the slide? Well, the bottom of the slide in the chart with the green columns, the average daily volume for the mini VIX futures rose 35% to over 16,900 in the first quarter. Now let's look at the table in the middle of this page. It shows the 6 dates since September on which the VIX index had its biggest moves and rose or fell by more than 18%, as you can see in the second column. So already at today's webinar, we've received several audience questions as to how one can hedge the downside moves in the SPX index. So I would say, well, see the 6th column in this table for the downside moves of the SPX index in red. So that's how the SPX moved on those big VIX move days. So one of the most important points of this webinar is look at how the mini VIX futures moved on volatile dates. Note the price movements for the first, second, and third month futures in the middle columns of the chart were not as big as those for the VIX index. The futures reflect the future expirations of 30-day volatility in the future and often are not as sensitive to big volatility moves today as the VIX index is itself. Some novice traders sometimes assume that moves in the spot and the futures will be roughly equal, but that is not how the futures work. Note the SPX index moved in the opposite direction, and the daily volume in the right column topped 47,000 on 3 of these big volatile days. Next slide, Kevin. So let's look at trading hours. So trading hours for the VIX futures and the mini VIX futures are nearly 24 hours a day, 5 days a week. At the bottom left there, you see average daily volume for the VIX futures in the first quarter was 237,000, including over 26,000 in the non-US global trading hours. So the table on this page covers a longer time period than on the previous slide. It covers the past 15 months because 15 months ago we were not trading the mini VIX futures. But anyway, this table covers the past 15 months and shows 9 dates on which there were big price moves for the VIX index. On all 9 dates, the VIX index again had bigger absolute moves than the VIX futures and the SPX index. And on these 9 volatile days, the average daily volume was a very robust 495,000 contracts. Next slide, Kevin. So if you do want to learn more, you could just dive in and look at what you see on your screen as far as quotes and whatever. But Cboe has been very interested in trying to grow investor knowledge of how the VIX futures work and the mini VIX futures work. So we have many research studies, and we also have benchmark indexes that try to show how hypothetical strategies might have performed. Let's show the next slide, please, Kevin. So there are several research studies out here, and on the left side here, I'm highlighting 3 of the studies, and I'm actually showing the URL web pages addresses for those 3 studies. So there's a study by the prestigious CFA Research Foundation, and also 2 long studies by Professor Edward Zada, one on buying of VIX futures and the other on selling of VIX futures. Both of those studies are 54 pages long. And if you do want more papers, please visit cboe.com/VIX. Next slide, please. Now, I understand that many of the attendees of today's webinar are based in Asia, and Asia-based investors might ask, well, how relevant is the VIX index to investors in Asia? Well, the VIX index reflects the expected volatility of the S&P 500 index, and about half the revenues of the S&P 500 stocks now come from non-US sources. And so one could make the argument that the SPX and VIX both now are global multinational gauges. Most of the trading volume for exchange-listed volatility instruments is focused on products based, though, on the VIX index. So let's review the columns in the 12-year table on this page from left to right. So in the first column on the left side, I'm showing 5 volatility indexes based in the US, Australia, Hong Kong, India, and Europe. All 5 indexes use the Vix methodology. The second column shows the maximum daily closes, and they range from around 66 to 104. The third column shows the minimum daily closes. Those are all around 10. So you see big ranges for all of these volatility indexes. The fourth column, all 5 indexes rose more than 50% in the year 2008. And the 3 columns at the right show the correlations of weekly returns. The volatility indexes had very negative correlations with their local stock indexes in both 2008 and during the entire 12-year period. And the 7th column on the far right shows that all the volatility indexes did have a positive correlation with the Vix index. Next slide, please. So the paper by Professor Zotto shows that in 2008, the 2 strategies that bought Vix futures both rose more than 110%, and the 60-40 traditional stock and bond strategy fell 21%. Next slide, please. So the paper by Professor Zotto also showed in 2008 that for the 2 strategies that bought Vix futures, both more than doubled in value with positive Sharpe ratios, and both had correlations with the S&P of around negative 0.82. Next slide, please. So the Vix index is meant to be just a gauge. It's not investable and it's not designed to show investable performance. So certainly people have said, well, how do I get exposure? How can I get exposure to the Vix? So Cboe and S&P both have introduced benchmark indices that are designed to show the performance of hypothetical strategies that buy and or sell Vix futures. So on the left side of this page, there are 3 benchmark indices that buy Vix futures. Strategy 1 buys and rolls near-term futures. The second strategy buys and rolls Vix midterm futures. And the third strategy dynamically allocates between long Vix futures, the S&P 500 stocks, and cash. So in this middle of this page, we show 2 Cboe indices that sell cash secured Vix futures. In addition, the VPN index also buys Vix calls. On the right side is an index that primarily sells Vix futures to take advantage of contango, but the index also allocates a small 10% allocation to buying Vix futures as a hedge. Next slide, please. So the S&P 500 Dynamic Vector Index in the green line rose 21.3% in 2008 and also rose in 12 of the 14 years at the table at the bottom. This index benefited from the fact that it held long Vix futures in 2008, and since 2008, its stock holdings have been helpful to its performance. So the S&P 500 Vix midterm futures, that's the index with the orange line, rose 83% in 2008 and rose 74% in 2020. But in most other years, it faced a challenge with contango, and the index fell in 11 of the 14 years in the table at the bottom. The index did not hold stocks and often fell in bull market years. And one might dismiss this index, but still one might say, well, because of the negative correlation here, could a small allocation to the index be helpful as a diversifier? Next slide, please. So how about lower volatility? Well, the S&P 500 Dynamic Vector Index had lower volatility and risk as measured by standard deviations and maximum drawdowns than the other 4 indexes on the charts on this page. So low volatility, even though VIX is viewed as a high vol product, the Dynamic Vector Index actually lower volatility. So next slide, please. So on the left side here, we see correlations. Assets with low or negative correlations can appeal to investors who wish to diversify. The correlation of monthly returns for the S&P 500 index and the S&P 500 VIX midterm futures index was a negative 0.71. So that might be a good diversifier. So on the right side, institutional investors often seek assets with higher risk-adjusted returns as measured by the Sharpe ratio. It's calculated as a ratio between the excess return, the return in excess of the risk-free rate, and the volatility of a given portfolio. And sure enough, the S&P 500 Dynamic Vector Index did have the highest Sharpe ratio in this table. Next slide, please. So the VIX index usually has been in contango about 70 or 80% of the time. So in light of the fact that the VIX futures usually have been in contango, the Cboe VPN index, the green line, sells VIX futures, holds T-bills, and buys VIX call options. The VPN index had big gains in 2009, in 2012, and 2016, when the strategy of selling VIX futures really became popular, and in 2019. In regard to selling of VIX futures, though, I would say definitely do your homework and be careful regarding VIX selling strategies. Contango can make them look very attractive, but there is potential for big losses if the VIX goes up by around 50% or more. The VPN index mitigates the downside risk by both holding cash and by buying the VIX call options. Next slide, please. So we're showing a table here, and the table shows the performance of 6 indexes that use VIX futures and the S&P 500 index. So I'd like to highlight for you the green arrows on the right side of the table. So in the second row, the short vol hedged index did have the highest returns of all the indexes on this table, but also had pretty high volatility. In the fourth row, you see the vector index, and the vector index had the lowest volatility and the highest Sharpe ratio. So certainly that is an index that might appeal to some prudent investors. And finally, down at the bottom, you see 2 rows at the bottom, you see indexes that had negative correlations, and those might be considered for diversification, but also watch out for the fact that they both also, though, had negative returns due to contango. And so those could be kind of challenged as far as a long-term, if you made a long-term buy and hold for large allocation, those 2 indexes, that might be a little problematic. Next slide, please. So as Kevin already mentioned, you can check out the VXM and VIX futures strategies for a number of goals, including risk mitigation, risk premium yield, long short volatility, and term structured trading. So there are many, many strategies out there, and we definitely would urge you to check out those white papers. There are many, many other resources. I'll turn it back to Kevin to close up. Kevin, please.
Matt, that was wonderful. Pretty much right up against time here, and we do have a handful of really good, really thoughtful questions. And my inclination in these situations, rather than running through not necessarily thoughtful answers to get through it quickly, is to let everyone know that Phillips will give us a list of these questions and the contact information associated with them, and we will make every effort to get back to you with a thoughtful response. So thank you for your questions. Keep them coming if you have them. We talked about a lot here, and there is a tremendous amount of information available on Cboe's website. We're home to the VIX and these tradable volatility products. There is a recently updated new volatility guide. I think that's something that could be very useful. And then there are a handful of other regular updates from the exchange of volatility blog and newsletters. You can feel free to connect with either of us on LinkedIn. We are genuinely grateful for your participation today. I think this is recorded. And for those of you who are listening after the fact, thank you very much for your interest. Ming, thank you for having us, and thank you to everyone at Phillips Futures.
Thank you very much.
Thank you very much for the insights tonight, Kevin and Matt, and thank you very much, everybody, for your time tuning into this webinar tonight. As mentioned by Kevin, for the questions we couldn't get to tonight, we will get back to you via email. And of course, if you have any other questions for Kevin and Matt, you can send them to us via the survey that should appear at the end of the webinar. We will also be sending everyone a link to today's webinar recording, so you can watch it again if you'd like to. Do sign up for part 3 of the series, where our speaker will be sharing real-world applications of the VIX at phillipfutures.com.sg/webinar. And that's all for today. Thank you, everyone, and goodbye.